something that I'd want to highlight out of what you just said, Arn, is the fact that it's a long-term investment play, right? In so many passive investors, this is kind of their first foray into something that's maybe considered an alternative investment, right? And most people are coming from the world of the 401k, which is highly volatile and highly liquid. And so there's this, it ingrains some maybe not helpful habits. I know for me, coming into commercial real estate out of that world, like you have to adjust your time horizon, you have to adjust your perspective. And I think it's important to be informed on what's going on in the world. I'm not saying bury our heads in the sand, but also to recognize that fear porn is a real thing, that the talking heads on the various networks their incentive structures are not always aligned. And so when you know you're into a longer term vehicle, just remind yourself of that as we head into a time that's maybe a little bit more volatile, a little bit more uncertainty.
100%. And I would say some people say, well, real estate is an illiquid investment, and that's a problem. I would submit for consideration actually being less liquid, less volatile than the stock market actually has some advantages because it prevents emotional reactions. And I can tell you, you're probably too young to remember, but in 1987, there was an event in the stock market called Black Monday. Mm-hmm. It happened sometime in October 87. So I was probably 33 at the time, probably just about to become a dad, and the stock market dropped 25% in one day. I panicked and I sold all that stock. Now, long term, that was a bad mistake. And I reacted emotionally to the current events, where with real estate, you can't push a button and liquidate assets. So I think it allows people to take a step back and not react emotionally. So yes, it's long-term perspective. I think the other thing I would say is, yes, returns may be a little bit lower the next 5 years than they were the past 5 years, right? I mean, I think investors got used to 17, 18, 20% IRRs. And I would just say, if you can make 13, 14, 15% IRR in a relatively safe investment during an economic downturn, that's a pretty good return on your money. Most people would be happy with that. So maybe adjust expectations a little bit, still understand you're getting a good return on your investment, and long term, you're going to win.
Yeah, I think comparing to the landscape is important, right? When equities are down 20% year to date, and you can get into an investment, even if it's just 10%, that's a really good spread versus, maybe the trailing 5-year average, where I don't know that statistic for the Dow off the top of my head, but I would imagine it's in the 10 to 12% range over the last 5 years. If you're only beating that by 3%, there's an argument to be had there, but we're not in that moment anymore. We're in a different part of the cycle.